In this video, I'm going to show you the 3 things you must do before investing. And stick around until the end of the video where I'm going to give you a bonus investing tip. Hi, I'm Jeremy Zargami, and welcome to my channel. Today I'm going to talk about 3 important things that you must do before investing your hard-earned money. And if you haven't already, please click that like button down below and consider subscribing and click that notification bell for more videos like this. Also, don't forget to get your 3 free stocks. 2 when you sign up for Webull, with 1 stock potentially valued up to $1,400 when you fund your account $100. And 1 free stock when you sign up with Robinhood. Let's get into it. Number 1, create a 3 to 6 month emergency fund. Before you put any money into investments, you should save up a minimum of 3 months of living expenses. So add up your rent, food, insurance, utilities, gas, unless you drive a Tesla. Subtle flex. Subtle flex. Just kidding. But seriously, unless you drive a Tesla, because I don't pay for gas. And then multiply it by 3. So for example, if your essential monthly living expenses were $3,000, you would want to save up $9,000 in your emergency fund before investing. You'll want to put this money in a high interest savings account. Most high yielding savings accounts are currently only paying 1% per year, but at least that will help minimize the effects of inflation on money that's just sitting there. Some banks to look into are American Express, Capital One, and Ally Bank. These 3 banks are currently offering savings accounts that are paying 1% interest with no fees. What you don't want to do is tie up this money into something you can't access quickly. You want this cash to be very liquid, which means you could take this money out of your account at any time whenever you need it. The reason it's so important to have this emergency fund is that you would never want to sell your stocks or real estate in order to pay for an emergency that you had. Having to sell off your investments could set you back years when it comes to your investing and retirement goals. Number 2, paying down high interest debt. Pay off any debt that has an interest rate of 6% or higher before investing. The reason is because that debt is racking up a super high interest rate that's constantly working against you. Paying off a credit card with a high interest rate is a guaranteed return on your money. Your return is whatever the interest rate is on that card. Most credit cards range from a 15 to 22% interest rate. So if you have a credit card that has a 15% interest rate, paying down that credit card is going to give you a 15% return on your money, which is a much higher return on your money than even the stock market, which averages about 7 to 10% per year. Don't let this discourage you though. You can still invest and pay off debt at the same time, such as student loans or car payments, as long as they're below a 6% interest rate. Number 3, decide what kind of investor you want to be. Before you start investing, you need to decide what kind of investor you want to be. You want to be a day trader, a passive investor, a growth investor, a dividend growth investor. If you have no idea what any of these are, don't worry. That's why I'm here. I'm gonna break this down for you. A day trader is someone who buys and sells stocks very quickly, usually buying and selling a stock within the same day, or sometimes within the same hour, or even within minutes apart from each other. They try to time the market and make income on quick little spikes in the stock. If you spent any amount of time searching finance videos on YouTube, you've probably run into a couple of ads of a few day traders trying to sell you on a course of how to become an expert day trader like they are. Expert. But day trading is extremely time consuming and very risky. Most people, especially beginners who try to day trade, end up losing a ton of money. It's basically gambling without the free drinks. So I highly suggest just staying away from this one. And just go to Vegas if you're feeling lucky. A passive investor is the opposite of a day trader. This is someone who wants to invest but doesn't have the time to pay attention to the market every day. They just want to set it and forget it. You guys remember that old infomercial with the rotisserie chicken? Okay, just moving on. This is what I do with my Roth IRA. I have it set to automatically buy stocks for me every single Friday. This ensures that I max out my Roth IRA every year at $6,000 and dollar cost average into an index fund without having to think about it. This method takes a lot of the stress out of investing because you aren't checking your stocks every day and worried if it goes up or down. You are slowly buying into the market at different prices for a long period of time, which will lessen the volatility of your investment. To set up a free Roth IRA account with M1 Finance, use the link below. Next is the growth investor. A growth investor buys stocks that they feel will give them the best rate of return on their money and aren't worried if a company will pay them dividends or not. Sometimes a growth investor doesn't have a very long-term plan for their investments. If their investment makes them enough money, they will sell out of it and just move on to the next hot growth stock. And last but not least, a dividend growth investor, which is the kind of investor I would consider myself. A dividend growth investor is someone that wants to buy stable companies that will have great long-term growth and pay and increase their dividends over the next 20 to 30 plus years. So not only will the company grow, which will increase your overall investment, but it will pay you more and more money the longer you hold on to it. The buy and hold strategy, in my opinion, is the best option. And dividend growth investing has been shown to pay the biggest returns over a 30-year period compared to these other types of investment strategies. Since you stuck around to the end of this video, here's my bonus investing tip. My bonus tip is developing the right mindset for investing. Stay even keel. When your investments go way up, don't get too excited. And when they go way down, don't get too down. And whatever you do, don't sell your stocks when they are down, unless that company is going out of business or something similar. Remember, you only lose money in the market when you sell. For example, think about your house. If your house went down in value, would you automatically sell it? No, that would be silly. You would just continue living in it until one day when you're ready to retire. And then you could sell it and move to Bali or whatever you want to do in retirement. Treat your stocks the same way. Buy and hold on to your stocks for the long term. And don't freak out when they drop below the price that you bought them at. If it's a stable company, use that as an opportunity to buy even more of that stock at a discount and wait for it to come back up. As long as you are choosing good, solid companies, it's highly likely that 30 years from now, you'll be very glad you didn't sell it. And that's my bonus tip, having the correct mindset for investing. I hope you got value from this video. Don't forget to hit that like and subscribe button. It greatly helps out this channel. Comment down below with any questions or feedback. I would love to hear from you all. Don't forget to get your 3 free stocks down below and sign up for your free Roth IRA account with M1 Finance. Links below as well. Thank you so much for watching, and God bless.